the Japanese yen is definitely not going to make it. This is something no investor is saying officially, but many investors are convinced of it by shorting the yen. They are borrowing yen to short it at the highest level since 2008. And the more the Bank of Japan retaliates by using its precious reserves to intervene in the yen, the more the yen just keeps on weakening anyway, despite all of their efforts. It just makes this group of investors feel even more certain. I am absolutely certain about this. The money I shorted, I am going to get back with a very nice profit. But I really want you to watch this clip as information to consider once or twice more, because what you think might be right, or it might not be. Because throughout the past 30 years, things have changed quite a bit. The fact that Japan's interest rates have been rock bottom, hovering around 0 to 1% or so, was that intentional on Japan's part, right? And what if this time Japan doesn't actually intend to let the yen slide until it collapses? If this specific moment is when Japan finally says they've chosen to save the yen so that their people can actually survive, if this time is when Japan says, I'm willing to take a severe hit from debt, but the Japanese yen must not die. And in that case, the specific party who ultimately has to foot the bill for this particular round might not actually be Japan after all. This video is sponsored by ZONTES motorcycles. They are really cool. They've been in so many videos that I'm starting to feel like I want to hop on the back of a ZONTES myself. And if anyone wants to support the Sand Money Monster channel, it's very easy. Just hit like, share, and leave a comment to chat with us. If you haven't subscribed yet, please go ahead and hit that subscribe button. And if you'd like to support the Sand channel so we can keep making great videos like this for a long time, you can become a member. Thank you. Now, this story starts with something investors didn't say, but they acted on, with a feeling that they were probably confident that the yen wouldn't survive. That is, let's look at the CFTC chart. It's a chart showing the net position of leveraged funds against the yen from 28 to 2026. Now, looking at this chart, you can see that at the far right end, the blue line plunges deep. This is the number of short contracts, which has touched 150,000 contracts. It's almost just like back in 2008, when things were really rotten during the hamburger crisis. Let me explain short simply. It means investors are predicting that the yen is going to plummet, weaken, and essentially fall apart. And if the yen weakens as the investors predicted, the investors will make money. Something like that. As for the contracts where we see that, wow, investors are betting short on the yen quite heavily, about 150,000 contracts. Let me tell you, this is just a part of it, because actual currency trading contracts are traded between companies and companies. Therefore, those trading agreements aren't included as data for us to see here. And of course, Sand can't show them to you. And if I were to explain a bit more, like, hey, what exactly is this? It's when investors borrow Japanese yen to short the yen because they are very confident that the yen won't survive. Why, you ask? Because over the past year or two, the yen has really weakened significantly. And investors became even more confident when they saw how the BOJ, or the Bank of Japan, responded to this problem. The BOJ responded by digging into their reserves to intervene in the yen. Just this past April and May, the Japanese Ministry of Finance spent as much as $73 billion buying back their own currency. You might ask, did that actually strengthen the yen? It did, but only for 3 weeks. Pouring $73 billion into the market is massive, yet the yen only held steady for 3 weeks before weakening again. So what did the BOJ do? They were determined to fight back. Even after that $73 billion intervention failed, the BOJ kept fighting. They kept fighting by raising interest rates by another 1%. But for heaven's sake, the central bank raised interest rates and the yen didn't go up at all. It just kept getting weaker. This made the gang of investors shorting the yen even more confident that Japan was definitely in trouble. Japan isn't going to make it this time. The yen is definitely going to crash. The short position I've taken is guaranteed to be a sweet payday. And another thing that made those investors who were actively shorting the market feel even more confident that they had bet on the right side was the specific data regarding the dwindling amount of reserves left in Japan's treasury. It really solidified their position. Because if we look at the amount of reserves in Japan's treasury, it's about 1.16 trillion US dollars. And let's just assume that if the BOJ wants to fight against the weakening yen by intervening in the currency, using ammunition to fire into the market. Let's assume the BOJ sets its ammunition at 73 billion US dollars, just like they did last April. That means the Bank of Japan would only be able to fire that 73 billion US dollar ammunition from the remaining reserves in their treasury about 15 more times. And then it's all gone. Anyone seeing this division method and says, oh, Japan only has 15 rounds of ammunition left. Is that thinking too simply? Yes, it is thinking too simply because this is Japan after all. Let me tell you, Japan is the original pioneer of modern finance that the United States had to learn from. For example, Japan cut its interest rates to 0 for the first time back in 1999. That was 10 years before the United States or the US Fed even. Japan started QE, or Japan was the very first country to have a money printing program, QE or quantitative easing in terms of monetary policy, modern monetary policy. They did it for the first time back in March 2001. And that was 7 years before the Fed did it in the United States in 2008 because of the hamburger crisis. So Japan is no pushover. They definitely aren't going to let anyone take advantage of them easily. So let's get back to Japan's current battle strategy in their attempt to prop up their currency. The method to prop up the currency, which we have to admit has weakened significantly. Basically, there's only one principle. There needs to be a massive increase in demand for the yen, or they have to pour a massive amount of money into this. A huge amount. But the limitation we discussed is that Japan's own treasury reserves are 1.16 trillion US dollars, which is certainly not a small amount. That's right, but it is ultimately limited. This is precisely why the BOJ, which we could call the commander of the land of the rising sun today, decided to implement a bold new strategy to mobilize the yen back home. There is actually a rather fancy economic term for this specific act of mobilizing money back home, too. It's called repatriation. After that, Japan took action. On July 10th, the Japanese Minister of Finance announced that they wanted the GPIF, which stands for Government Pension Investment Fund, the largest pension fund with a value of 1.8 trillion US dollars, to shift their investments from foreign assets back to assets within Japan. So you might ask, how do they actually go about bringing that money back home? Honestly, it's not difficult at all. It's very simple. Other countries just do it by simply calling for interest rate hikes. Because if any country offers high interest rates, investors will think, oh, it's better to put our money here because the returns are higher, you know? But regardless, in the past, no matter which country it is, decides to raise interest rates, there is nowhere else where a rate hike is as terrifying or shocking as when Japan raises interest rates. And believe Rule, the fact that Japan has announced that they are going to raise interest rates, it is a very serious matter for the capital markets, because in modern financial history, every time the yen strengthens rapidly, something always breaks. In 1998, the yen appreciated by 15% in 3 days, causing long-term capital management, which was a hedge fund, collapsed because they had borrowed yen to invest. In 2008, the yen strengthened throughout the year. And that year, the subprime mortgage crisis occurred in the United States. Even the Americans themselves at that time were probably confused, thinking, hey, what's going on? I don't hold any assets from Japan at all. Why is my mortgage interest rate being determined by Japanese money? The reason is the same, because they borrowed money from Japan to invest. In 2011, the yen hit an all-time high, making the whole world worried and freak out. because at that time, the whole world had borrowed a lot of yen to invest. March 2020, during the COVID was raging and the yen strengthened, causing assets worldwide to be sold off. Why? Because the people selling them off had borrowed yen invest. In August 2024, not that long ago, the Central Bank of Japan raised the interest rate by 0.25%. It was very little, but that caused the yen to strengthen in a single day, causing the Japanese stock market to plummet by 12%. That day was the worst day for the Japanese stock market since 1987, and the United States stock market, the Nasdaq plummeted down 3%, while the S&P 500 was down 3%. You might ask why? Well, to put it in a way that's easy to visualize, I'd say it's because the yen determines how the world uses money, EY, or how much leverage is being used in investments. And if everyone is borrowing yen to invest, why? Because the yen has a low interest rate, right? At around 0 point something. But the yen suddenly strengthens. What does that mean? It means the financial cost of the money everyone borrowed goes up. And then when suddenly our debt increases unexpectedly, it causes all sorts of problems, whether it's a margin call, forced liquidation, closing positions, or what's collectively called a yen carry trade unwind. And some people still don't understand why anyone would borrow yen to invest elsewhere, right? It's because the yen has low interest rates. The yen's interest rate was at 0 for a period of time. And suppose you take that to buy US assets, bonds that offer an interest rate of 5%, that's the gap, the spread you can profit from. Get it? Still don't get it? Okay, let's make it even simpler. Suppose you borrow money from your mom, like, "Mom, can I borrow some money?" Then you take that money that you borrowed interest-free from your mom, right? Then you lend it to a friend, telling them, "I'll lend it at 5% interest," and you pocket the professor, the 5% interest you charged your friend. Get it? Now, as for why this weakens the yen, I'll show you a graphic. Basically, when they borrow yen to buy foreign assets, they must borrow in yen, then exchange it for another currency, most likely US dollars. Then they take that money and change it into foreign currency and use it to buy foreign assets. When they do that on a large scale, the yen will keep getting weaker and weaker. Get it? If not, watch it again. Let's continue. We'll go back to what I said earlier about how Japan, central bank chiefs said they would bring the yen back to Japan. The strategy they are using to fight back is that said, hey, they're going to bring the yen back home. They're going to make the yen stronger, which if it does get stronger, like if it strengthens this time around, it's going to be the scariest thing, more than any other time in modern financial history. Because whether it was 1998, 2008, 2020, or 2024, whenever the yen suddenly strengthened like that, every time it strengthened, because it was unintentional. Unlike this time, when Japan explicitly announced that it was intentional. Now, back to the question, why, after all this time of keeping interest rates low, did Japan suddenly decide to raise them? Isn't it better to be the lender? Well, the reason Japan was able to keep interest rates that low in the past is because there was a financial mechanism in place, but part of it was because Japan has been experiencing deflation all along. For the past 30 years, Japan has had no inflation. No inflation means things aren't getting more expensive, but things not getting more expensive means that salaried employees never cared whether their salaries would go up or not. They never demanded a raise until COVID hit. The United States pumped money into the system, in so many different ways, trillions of US dollars. At that time, asset prices were inflating everywhere. It was a global trend, and Japan didn't escape it. It had to inflate as well. In 2022, Japan's inflation rate hit 2% for the first time. After being in deflation for so long, inflation suddenly spiked, which was like a huge shock. And so at that time, inflation is global, right? Other countries solved the problem by raising interest rates across the board. Canada, Europe, and the United States all raised interest rates by 5%. Japan was thinking, what should we do? Should we raise interest rates or not? Let's look at our debt is at about 200% of GDP. What should we do? Let's do this. If we raise interest rates right now, even if it's just a little bit, our debt interest will increase massively. What should we do? And we also have to be the ones lending money to this world. Let's do this. Let's keep the interest rate pegged at 0%, my friend. Ready? Let's go. And on the day Japan decided to peg the interest rate at 0%, when the world was already facing inflation, that triggered a currency collapse. It happened immediately. Every other country raised interest rates, but Japan was the only one that kept stepping on the gas. Interest rate at 0. So what happened was the yen flowed out of the country like crazy. As I explained, people would borrow yen, exchange it for other currencies, and go buy foreign assets. And on that day, what happened after COVID was that the United States raised interest rates to 5%. And this is the profit gap that people wanted to take advantage of. What happened that day caused the yen to weaken a whole lot. From back then, the yen rate was at 1/10 of a dollar. Yen to $1, it weakened to the point where you needed 150 yen, 160 yen per dollar. See? It takes a much larger amount of yen to exchange for the same $1. The subsequent result after the currency collapse is one of them. Thai people love it because traveling to Japan has become cheaper. Japanese people don't love it. Why? Because Japan is a country that has to import a lot of resources. Japan produces about 100,000 barrels of oil per day, but Japan needs to use about 3 million barrels of oil per day. This means that Japan has to import about 97% of its domestic oil demand. And when the yen weakens, who cares if traveling to Japan becomes cheaper? But Japanese people have to import all the resources that they used to import, and it all becomes more expensive. And what happens next is Japan has never had inflation, has it? Was the first time there was inflation where goods became more expensive. For 30 years, things never got more expensive. Can you imagine how shocked the people were? And when that happened, it became the first time that Japanese people demand a raise. And you might ask, did they get it? Yes, they did. Japanese people got a salary increase. Look at this bar, the red one on the far right. This is the biggest salary increase in Japan in 3 decades. And when everything was going bad with inflation and people starting to ask for raises, the company structure started to change. Japan has to import energy at a much higher cost and import food at a much higher cost too. America added the topping of the Iran war, and that made everything much worse. The thing that makes it even worse is that 97% of the oil that Japan has to import is mostly imported through the Strait of Hormuz. So this situation forced Japan to take a step back and look at each other again. Like, hey, we need to reconsider this, guys. What should we do? There are only a few options. Option 1, keep doing the same thing, keep the interest rate pegged at 0, because look, given our debt, our internal factors, our debt is over 200% of GDP. If we keep the interest rate pegged at 0, the first point is that our debt burden won't be that heavy. We'll still be able to manage the debt. And if we look ahead, and for the rest of the world, any asset in the world, it won't scream, it won't collapse. But on the other hand, the yen will definitely hit rock bottom. And if the yen collapses, this effectively means the savings of the people in our country will just vanish like that. Everything they worked for their whole lives. That means with this choice, the people of Japan won't survive. If so, what's the other way? The second option is to raise interest rates. For this path, the government has to bear a debt burden that's absolutely gut-wrenching because Japan's debt is 200 debt immensely. But this specific path will effectively prevent the yen from collapsing. It will prevent personal savings from being completely wiped out, and the Japanese people will still manage to survive, even if they have to survive in a somewhat battered state. And another critical point to consider is this one. This is really important, that if Japan raises interest rates intentionally, it will cause anyone who borrowed yen to invest to collapse. Which begs the question, right now, between protecting their own currency, protecting their own people, versus letting the common people suffer, which one would Japan choose? The answer is that Japan would choose the second option. Officially, this is the first time in a generation, in the last 30 years, that Japanese government bonds have offered real returns. The 30-year Japanese government bond now offers a yield of 4%, which means this is the first time in 30 years that it's not, whether it's insurance companies, large pension funds, or any other Japanese investment funds, they are all looking back at Japanese government bonds and saying, hey, we really should be putting our money there. Here, where we can secure reliable returns within our own country for sure, where it's all in our own currency, and where we can feel confident in the stability of our investments, where we don't have to deal with exchange rates. There's no exchange rate risk at all. Hey, let's take a look. Yes, and this is the first time Japanese money is rallying back home. Now, let's look at this chart from Bloomberg. Right here, this last bar is the amount that Japanese insurance companies have bought of Japanese government bonds, the most in the past 3 years. I'm telling you, if Japanese money decides to pack up and head home together like this, the misfortune that should really be in Japan might just end up landing right on the US market. Because if you ask where Japanese insurance companies get the money to buy bonds, they sell US government bonds to buy Japanese bonds. That is the core principle, the fundamental strategy used to raise capital and capitalize on the interest rate differentials between the two markets. Yen back home. So I'm going to show you a diagram of how to bring the money, yen, back to strengthen. So the government raises interest rates, right? That will make Japanese government bonds and such offer higher returns. What will happen is that people will sell US government bonds for dollars, then exchange those dollars for yen, and then use that Japanese money to buy assets in Japan. And whenever there is demand for Japanese currency, when there's more demand, it will strengthen on its own. As for the US government bonds being dumped, Japan is probably thinking to itself that it's America's problem. And if you ask me, it really is likely to be a problem, because in the past, Japan has been the largest holder of US government bonds. Now, if Japan decides to bring its money back home, then in the next bond auction, they might not have Japan as a buyer, major customer anymore, right? Let's wait and see. And before we go, I want to leave a message for those who are currently shorting or thinking about shorting the yen. It's a message on social media from an account that suddenly gained a lot of followers, an account named Yuto, who said that the measures that the Bank of Japan is preparing, this will have a profound impact on the lives of billions of people, and it will also have a significant impact on the lives of people living in Western countries. I apologize deeply for this. Please understand, this is not personal. God bless.